Hi, this is Jim Cunningham. I've got Christina Lindsay and Austin Fitch here today to talk about understanding your investments and navigating economic shifts. I don't know about you, but it's been a little gut wrenching. We're in May of 2025, and I've seen my personal portfolio go down, then come back up. So thank goodness I didn't sell. I'm not a market timer. As a wise person once said, the Market Timers Hall of Fame is a completely empty room, meaning there are no successful market timers. So, good stuff here today. If you're watching this on YouTube, please subscribe to our YouTube channel. We do these, and also go to our website and sign up for a webinar because we do these live. We do have a Q&A, and so for those of you watching this live, you can post your questions and we'll answer them live, but we don't put that on YouTube. If you're watching this on YouTube, please ask your questions in the Q&A or the comments area, and we will go ahead and answer those. So what we're talking today is the economy shifting, investments are hanging in the balance. We're looking at a long-term picture, maybe 2 or 3 years is kind of the time horizon we're looking at. The question is are you prepared, or do you feel like you're prepared, right? What is your gut telling you? And if you're like most rational people this year, your gut has been kind of going in different directions because it's been a little scary watching investments go down and then coming back up. What about inflation? Has that calmed down? Will it keep going up? What are the smart kids saying? And we got a couple of them here today. And could a recession be looming? Is that on the horizon? I think we're all a little spooked about sort of this. Those of us who lived as adults through the Great Recession of 2008, we're always worried that that ghost of 2008 will somehow rear his ugly head and show up and drag everything down. But we're going to get some answers from some really smart people here joining us today. I'm not going to do a lot of talking. So normally I do a lot of talking. It might not seem like I'm doing a lot of talking right now, but I promise you I will stop talking soon. But I'm a partner at Cunningham Legal. I've been an attorney 30 years. We have offices throughout the state of California. I'm a certified specialist in estate planning, trust and probate law, a real estate broker, securities insurance licensed, and a single engine pilot land instrument rated, although I'm not current. But you know, Christina, I'm thinking about maybe it's time to pick it up again. I don't know.
I think so.
These are the lawyers in our firm. We are dedicated to all things the peaceful transfer of wealth from one generation to the next. So we help people set up estate plans. We help people administer, which is kind of, dissolve a trust or settle a trust. And we also help people with business matters. So small business are related to family business succession. Christina Lindsay is joining us here from Ascent Wealth Management. Alyssa Kroger and Shannon Behan are her other partners. They're not joining us. And Austin is also joining us. And this is our legal disclaimer. I'm a lawyer. When I say you, there is no attorney-client relationship. And just because I'm looking at you does not mean there's an attorney-client relationship. This is information only. And really, a lot of this should be done with the advice of a financial advisor. And when we talk about the estate things, it should be done with a qualified estate planning attorney. And Christina, you talk about your disclosure, and then we'll get started.
Yeah, we are licensed with both a broker-dealer registered with FINRA and also a registered investment advisory firm registered directly with the SEC. So again, much like Jim, this is not individualized investment advice. So everything that we're talking about today is very much general information and not any specific recommendations. So we want to make sure that anything we do that is a specific recommendation is always in the best interest of the client, as we are fiduciaries and held to a higher fiduciary standard. So this is for informational only purposes. And Horizon's disclosure, because they have the same types of disclosures we do. And I think we're good because that's pretty much the same disclosure since we're all held to a higher standard. But
now that we got all that out of the way, let's get to the heart of it. Today's topics: uncertainty, tailwinds. Should we diversify? What do we do going forward? And I know, Christina, a lot of people are in retirement. They're close to retirement. They could be really far from retirement, right? So we get a lot of people calling us. They say, Jim, I've got a good job. I'm in my 30s, maybe my 40s. I'm saving for retirement. I've watched your videos. I'm paying attention to this, but a lot of people are really worried, especially right now, because there's a lot of uncertainty. And I think we see that in the headlines, this sort of uncertainty. So I will let you, Christina and Austin, take it away.
Yeah, I'm going to pretty well turn it over to Austin here, and we can kind of make this conversational if we have some questions too. But I heard an interesting statistic yesterday because I did get some other economic updates that some of our other partners in the industry put on an economic update forum yesterday. And the statistic was that 30% of Democrats feel that that they are bullish on the economy. 60% of Republicans feel that they're bullish on the economy. And so economics and investing should not be political. And I think that that's really where our job is to help clients have a disciplined approach to where the politics and emotions are taken out of things. And we're looking at fiscal policy. And it's also the market will short term react to uncertainty with political headlines that is anticipating what a potential fiscal policy can be, but you really can't change a investment portfolio until you have implemented or what will be implemented actual fiscal tax policy. So I think what we want to do here is kind of let's try to strip the headlines and the media and the political headlines out of this, and let's bring it back to basics and what's going on with the economic outlook, kind of what are we dealing with? And Austin, can you help us make some sense of it?
Absolutely. Yeah. Christina and Jim, thanks for having me. Yeah, we're absolutely going to talk about some of that short-term uncertainty because Christina, as you mentioned, just what we've seen over the last, at this point, 6 to 8 weeks has been nothing short of, of chaos in certain areas of the market and the economy, just in terms of some of the unknowns. And that, I think, has created that uncertainty. I think the first chart that we have in here really speaks to just the level of shock to the system that we saw following kind of what was called Liberation Day, but the announcement of the tariffs by President Trump. And again, just looking at this chart, it becomes really obvious really quickly that the announced and proposed tariff rate, again, full well acknowledging that we at Horizon, and I think most folks would agree, we're probably not going to end up there. But what has currently been announced would put us back at a level that we haven't seen since before World War One. And that's part of the reason that you saw the market respond the way it did. You talk about uncertainty, you talk about kind of the unknown. Generally speaking, nobody that was alive back when tariffs were as high as they were in 1912, 1913 is even alive today, much less investing or dealing with the economy. Typically, and you can kind of see it over the last 70 plus years, tariffs have been in the low to mid single digits, and they also have moved very slowly over time. So the shock to the system that we saw there in April is really what kind of upset the apple cart like I said, from a market standpoint. You can make the case that it was more of a negotiating tactic. I think that's one thing. And if folks take one thing away from kind of the conversation today, I would tell you this. There are two sides to the spectrum in terms of tariffs, and it's really still kind of waiting to be seen where we end up. But think of it as one side is the administration actually believes that tariffs are really strong policy and that's how they should operate with very high tariff rates. The other side is that they believe they should use tariffs as a negotiating tactic, and to do so, that will drive more beneficial trade terms for the United States. I would tell you our view, and I think the market's view as you see it, is the closer that we are along that spectrum to the negotiating tactic, the better that is for the markets, and realistically, probably better for the economy longer term as you talk, like you were saying, Jim, 2, 3, but also probably 5, 10 years out. The closer that we are to policy, the bigger that headwind is to economic activity. We've seen it just over the last few weeks. We're probably trending more towards a negotiating tactic in terms of that announcement that happened in April. You've seen the other countries coming to the negotiating table probably much more quickly than they otherwise would have if you hadn't had that massive announcement. But the shock to the system was the market reacting to a tariff rate on average that hadn't been seen in over 100 years.
Yeah, we do have this in formats where there is no video. So what we're looking at is we're looking at in 1909 tariffs were broadly speaking 23%, and then they dropped to basically 1% around 2010, and it's just kind of steadily going down. And now they've kind of hockey sticked up to where they were in 1909, basically. So it's gone way back. To your point, Austin, these are the highest tariffs we've had since 1909. It should be noted in 1909 we did not have an income tax. So income tax was created in 2013, 1913, and that correlated with a real drop in tariffs. So
Yep.
we adopted more of a graduated tax system where the more you earn, the more you pay in tax, as opposed to sort of a tariff-based system without an income tax. So that's what happened. So now we have income tax and tariffs, but again, that's the uncertainty part. So this is really important because when you see your stock portfolio go down 20%, and it came back, it's back basically almost to back where at least the S&P 500 is within 3% of where it was from the all-time high. But a lot of people go, is there a problem with the economy? Is there something going on with the economy? And what I'm hearing you say, Austin, is it sounds like your opinion is that this is more about uncertainty than it is about some real sickness or illness or problem with the U.S. consumer or the U.S. economy.
Absolutely, Jim. And we'll talk more probably as we continue the conversation. But the next couple slides speak just to that, is this idea of uncertainty really kind of is looming over, hanging over. It's a cloud, whatever you want to call it, when it comes to the markets. So the Fed puts out kind of what they call their beige book. Think of it as every time the Fed meets, all of the governors aggregate data and analytics and comments on the economy. Normally, they mention or use the word uncertainty somewhere 10, maybe 20 times over this hundreds of pages of document. They mentioned it 80 times, so almost 10 times more than average on the most recent version that came out in April. That again just speaks to this overhang. And then if you actually look at kind of economic policy, there's an index that actually measures economic policy, and that's kind of the next chart that we have for those of you that are watching on the screen. But just to kind of paint the picture, is there's an index that actually Bloomberg puts together on economic policy, and basically it just speaks to how are people making decisions, or are they hesitating when making decisions when it comes to economic activity. We're as high as we were kind of in the depths of COVID. And if you think back to how uncertain things were March, April 2020, it's crazy to think that we're there from an uncertainty standpoint just over the course of basically a couple weeks worth of decisions that were made. I think that the next piece then really translates into, okay, so if we talk about it in aggregate, right, uncertainty is massive, but let's drill down into, okay, how's that affecting investors and in some senses consumers? If you talk about sentiment, Jim, you're kind of alluding to the fact that unfortunately investors oftentimes do what they shouldn't do when they shouldn't do it. If you think about investor sentiment, how do investors feel about markets? If you actually look at how investors feel today, it's as low as we've been since the SVB kind of regional banking crisis that we lived through a couple of years ago. But it's also kind of at the same levels of the great financial crisis. It's at the same levels of some of the other kind of think of it as crises that we have lived through over the last decade. And again, we got there overnight as opposed to kind of seeing this one coming to some extent.
Yeah, I mean, that's really good to note is it Warren Buffett that said, buy when everyone's selling and sell when everyone's buying. And I think if I could roll the clock back when there was this drawdown recently, I'm like, man, why didn't I put some more cash into investments? But again, that's goes to market timing. I guess the flip side of that, Christina, is does it make sense at all to time investments or not? I mean, what do you think about that? What's your feeling on that? Because that's actually a common question clients ask me is, should I just be timing stuff, right? I mean, does that make sense?
So, timing from a sense of like hey, trying to sell when you're, if fearful, timing based on emotions, never a good idea. I mean, I think that you just have to have a disciplined approach, because again, it goes back to people's emotions can cloud their financial judgment, their politics can cloud their financial judgment. And so, I think even if we look at the most recent time when the market was down, 10% in a day,
Yeah.
any of our clients that did have cash that was in the market to be deployed, one of the things that we're very good and disciplined about doing is any new money that is getting into the market is what we refer to as dollar cost averaging it. So we will dollar cost average into the market when we're investing new cash for equity investment, so or bond for that matter, to catch the bond market at different cycles. So that way you're not catching a whipsaw on any given day. You're not all of a sudden investing at a high or a low. You're systematically and disciplined approach going to put a little bit to work each time. But if we do see a massive pullback where we saw that 10% drop in that single day, we did put clients to work. And actually, some of those clients were like, oh my gosh, should we be selling?
Yeah.
Absolutely not. We put money aside to deploy to equities. This is money we're not touching for the next 5 to 10 years. This is the time to be aggressive and get that money to work. So, and they're super happy we did. And what I tell people is, look, even if that market was down 10% and went down another 5% the next day before it rebounded, it didn't. It snapped right back, like 9% the very next day, went to the upside. But if it did continue to fall, it's like trying to catch a falling knife. You're never going to catch that perfect bottom. But if we got it at a 5-10% discount, it fell 5% further before it rebounded. Over time, if we're investing in the equity markets, we're going to have time on our side. Now, if we're same thing on the flip side is if we're having to take distributions from a portfolio, we want a dollar cost average out of the market so that we're not taking all of your needs out of the market when the market is down. So we want to make sure that we've got money set aside for distributions as well.
So let me ask you then. So, because again, this comes up when I'm meeting with clients about estate planning, is if somebody says, okay, I've got a $2 million IRA rollover and I'm leaving my company, I'm 60, I'm not going to start taking this money until I have to, which is age 73. When you say dollar cost average, if I have $1 million in cash and I roll that over, are you putting in like 100,000 a month? Is it 50,000 over 24 months? What's the typical kind of thing? Or is it like half and then a quarter and then a quarter? Or is it just straight, 100 per month or something?
It depends on the size of the client, their portfolio, their needs, certainly. But for like, if I had $1 million, we're probably going to do that in 3 tranches.
Okay.
And so those tranches would typically be systematic, where we say, okay, tranche 1 is going to be in 30 days, tranche 2 is going to be in, call it 60 days, and tranche 3 is going to be in 90 days, or it could be a different schedule. But again, we can choose to accelerate that schedule. So I know Horizon helps us oversee some of our portfolios for our clients. And I think we reached out to Horizon and said, when the market was down, anyone that has tranches, get one of those tranches in. I'm not saying put all in, but put one of those tranches in, and let's accelerate the timeline because we have a great opportunity.
And the other thing we've covered in other videos is on our YouTube page is what happens if you invest kind of like everything and then the market tanks versus dollar cost averaging. So this is really important. So if you're watching this or listening to it and you're retiring, this is really, really important because not all advisors do this. And spoiler alert, advisors get paid when they deploy your capital. That's just, I'm going to pull the curtain back on this. A lot of times they go, gee, well, if I sit on this for 6 months or 90 days, I'm not going to get paid for 6 months or 90 days. And that's not the way people should be doing this. Okay. So it's very important to listen to a quality financial advisor like Christina, right? And help you deploy this in a way where you won't get caught investing everything and then a month later the market drops and now you're at a real disadvantage. And again, we cover that in other webinars. But listen, I will turn it back to you guys.
And Austin, I would think that just in what we've seen in the last month with the art of the deal that we're kind of living through right now of the tariff negotiations. But I think you guys have put out some marketing pieces too, that a lot of the massive trade uncertainty with regards to tariffs is kind of the volatility related to that is kind of behind us because we've seen so many trade negotiations and other countries come to the table. So do we think that there's still quite a bit of uncertainty in the short term, but do you think that the massive trade uncertainty is kind of somewhat behind us?
Yeah, no, that's a great point, Christina. And The funny part about all of this is if I had, for that matter, if we had created this deck a week, maybe 2 weeks ago, even, it may have looked different, right? The speed with which things are changing is kind of breathtaking. But Christina, you're absolutely right. I would tell you with what we've seen just in the last few weeks in terms of countries coming to the table to negotiate and the progress that's being made, we're much closer to that negotiating tactic side of the spectrum where it looks like most of the volatility is probably behind us from a market standpoint because the volatility existed because the market was kind of dealing with the fact that maybe this is actually economic policy. It's looking more and more like it's probably not, true and significant economic policy. Sure, tariffs may go up marginally, but a marginal uptick in tariffs, say we even go to, back to 5, 6, 7%. That's something that the U.S. economy, because of some of the underlying strength, we'll actually talk about that in here in a few minutes. Because of that underlying strength, we can probably handle that. The market was dealing with the fact that a 22% tariff rate is something that we probably weren't prepared to handle over the next 2 to 3 years. Now, long term, maybe it would have worked out, maybe not, who knows? But I think what you've seen, Christina, to your point, is just over the last 3 or 4 weeks, you've seen a lot of progress in terms of getting rid of some of that uncertainty or putting it behind us. Now, that being said, and Jim, you brought up this slide, I think this is where we talk about investor sentiment kind of being at lows that we've seen over the last 20 plus years. I mean, this is a chart that looks at the last 30 years it's a survey data from the University of Michigan. And basically they asked the question, do you think a year from now your economic situation, your financial situation is going to be better or worse? And then it nets out the two. So if it's a negative number, more people think it's going to be worse. If it's a positive number, more people think it's going to be better. The long and short of this is kind of 2 takeaways. One, again, for those of you that can't see it on the screen, over the last 30 years, there's really only been like 3 very short instances where this number has ever been negative. That would be the great financial crisis, and that would be kind of the depths, coming out of COVID and some of the inflationary kind of hikes that we saw there in 2022. Fast forward to where we are today, and you're as low as we've ever been in terms of expectations for consumers. That speaks to this uncertainty piece. And again, to Christina, your point, a lot of that's probably behind us from a market standpoint. I think what we're watching here at Horizon is, does that start to impact the consumer in terms of their uncertainty, their spending habits, those types of things? Because if it does, you're looking at potential negative impact in the future. We at Horizon don't necessarily think that that's going to play out that way. We think this reverts back pretty quickly in terms of expectations. But you absolutely could have some overhang.
I mean, I will just personally, I probably shouldn't even say this, but the AI is really changing the legal industry. The single biggest barrier to hiring a lawyer is cost. It's just too expensive.
Yep.
92% of people that would otherwise consume legal services don't. So this is a market could explode 10x if lawyers could get hyper efficient. And I think we're on the cusp of getting hyper efficient. So that's a net positive. So it's very interesting that there's a lot of negativity right now. And if you look at the technology side, and we have a lot of clients who are in tech, Christina and I have mutual clients who are tech people, and these are people who are really smart, and they're like at the epicenter of where this stuff is happening. And I am super excited. I will just tell you, I think our best days are ahead of us. They're not behind us.
Yep.
But that's my little...
Yeah. No, I think our view here at Horizon is that this is more of kind of a faulty data point. I think this next slide, though, Jim, that you just brought up, speaks to maybe why there's some of that feeling from a consumer. So you're looking at a couple different graphs, and it was a 2-question survey by the Financial Times. First question was, would America be better off if there were more people that worked in manufacturing? 80% of people said yes. The second question was, would you be better off if you worked in manufacturing? Less than 25% of people said yes. There's this disconnect that exists. And I included a little political cartoon, and it's right. Who wants the factories to come back? Everybody says yes. And then who wants to work in those factories? And nobody raises their hand, right? That's what we're living through. And that's again, you talk about this idea of Everybody on the surface says, hey, bringing jobs back to America is great. Bringing manufacturing back, bringing industrial production back, right? Those are all awesome things. And then you ask, okay, who's going to go work in the factories? And everybody says, well, not me. Like somebody else can go do that. And I think that's the difficulty that we're working through. Now, Jim, you kind of alluded to it. And I think the next slide kind of highlights some of the efficiency gains. Like, yes, we absolutely can bring some manufacturing back and probably be much more efficient than maybe other countries, and we have been historically as a country. But like we are reconciling with this, if we bring manufacturing back, are those the jobs that people actually want to have? And I think that's the struggle to some extent.
Isn't it like 45% of uh, Gen Z wants to be an Instagram influencer or something?
Yep.
I mean, it's just like, I don't see those people working in a factory. But,
Not at well. So
I mean, my great grandfather was a farmer, and everyone before him was a farmer. And then
Yeah.
my grandfather was a tool and die maker at General Motors.
Yep.
The factory worker. My dad was a lawyer. It's typical, well, not necessarily typical, but it was this, you're doing a different thing than your father did. Of course, I'm a lawyer. But my point is, I don't see my son going to work in a
Right.
factory
Yep.
or go be a farmer. There's nothing wrong with being a farmer, but you just don't see it that much. So
No, you're absolutely right. And you can both of these charts on this screen for it's basically telling you that the overall employment numbers, whether it's in manufacturing or agriculture, have either been flat in absolute numbers, have either been flat or gone down over the last 75 years. Now, efficiency has absolutely gone up. Output, production on all those, measures have gone up multiple times over, but the number of individuals that are working those jobs have stayed the same while the general population has grown substantially over the last 75 years. So
Austin, you probably seen the same thing, and this plays into the politics. I think the number one occupation in something like 27 states is long haul trucker. And when we have autonomous driving long haul trucks, which is going to happen this year, next year, 10 years from now, whenever it is, all those people are going to lose their jobs, and they're all red states.
Right.
So those people need to do something else. And I think the average age is like 51 and, I think a high school diploma.
Yes.
So what's going to happen to all those people?
Yep. No, and again, that speaks to some of that uncertainty when it comes to this idea of, and I would say it this way, we at Horizon think the concept of kind of the trade war, trade negotiations, probably for America over the very long term, I'm talking 10, 15, 20 years, like it's probably in our benefit to renegotiate some of these trade deals, right? If you actually look at many of the trade deals, like they were very accommodative to other countries around the world. We can take a step back, and I think collectively, regardless of which side of the aisle you're on, you can probably make the statement that it would be in our country's best interest over the next generation plus to have slightly more beneficial terms. Now, that's not saying they should be equal and reciprocal and those types of things. They're just moving in that direction, right? That being said, if we do that, then Jim, to your point, like there are going to be areas of the economy where there are holes that people, at least for the last 25, 30, 40 years, have not wanted to fill.
Yeah.
So
yeah, and tariffs as a reminder, just for everybody, there's really 3 R's of tariffs. It's either to generate revenue, to restrict. So if there's too much of some good, or we're not able to export enough of our goods because of the trade rate, then you want to restrict and put restrictions either on ourselves or on other countries, or it's for reciprocity. And this has all really been about reciprocity. I mean, for a little while, you could argue as, the restriction with steel and how, China was, selling it to Canada, and then Canada was marking it up and selling it back to us, and we weren't able to sell our own steel. And so you've kind of got some of these, nuanced things. But most of this is reciprocity. And again, I think that it is kind of going back to what Austin said, it's the negotiation tactic where we're starting to see that component of uncertainty come out of the market. But you also have taxes. And I think this is the other thing that we're waiting on really is to see what's going to happen with tax legislation.
Yeah. And that's where, I mean, we've gotten the question, and Jim, you kind of mentioned it earlier, should we expect inflation to go back up because of the tariffs that are being talked about? I would say it this way, tariffs over the long term are deflationary, and that's because they tend to suppress demand, right? They're in essence, and we kind of say it on the slide, tariffs or taxes by kind of default, they're just added cost put into a good or service. Over the short term, though, you may actually get a slight uptick. You can kind of see that on this chart. The short term kind of expectations for inflation did tick up over the last couple months, but I would tell you long term, for those of you that are maybe worried, hey, are we heading back into a 2021, 2022 inflationary environment? Probably not. Probably what you'll actually see is inflation come down, because and again, all this is if the tariffs remain at a meaningful level, you would start to see some sort of reduction in demand. So
when you're talking inflation here, this is like an off the record question. Is this accurately capturing the cost of housing?
Yeah, I mean, it does include the cost of housing. I would tell you what's interesting if you look at and again, there are a number of different ways to look at inflation. But if you look at the aggregate measures, they do incorporate housing. Now, that being said, and I think where you're going with this, Jim, is right, housing prices have gone up multiple times over, right? It doesn't matter where you live, right?
The amount
for me in North Carolina, for you in California, I'm sure it's the same.
It's the same, because what I'm talking about is the amount that a typical person spends as a percentage of income on housing. It's like 40% or something. It's like the single biggest expenditure, and that used to not be the case.
Yeah,
I mean, it's like topic for another day, but
yeah, well, and I think the reason that you're seeing that, and this goes back to some of those efficiency gains that you talk about, is you've actually generally seen prices stay the same, or in many cases come down in many other areas, and that has offset some of the real estate. If you actually, I mean, we had friends looking to buy a new TV, and in their mind, right, from 10 years ago, you're going to go out and buy a 60, 70, 80-inch TV. It was going to cost you an arm and a leg. Right? You might as well buy a new car. And now they got this massive TV for their family room for less than $500.
It's like taking your family out for Mother's Day brunch. It's the same price. It's like, what?
Exactly.
Like, why is everything so expensive in a restaurant, and why is the rent so gosh darn high?
Right.
I'm seeing this with my kids. They're in their 20s, and what people are paying for a 1-bedroom apartment in the Sacramento area, which is not necessarily a high-priced area. It's just mind-blowing.
Yeah.
Anyway.
Yep. All right. So we've talked uncertainty. I think we've beat that horse pretty good. I would say, though, the thing that we should be looking at as well is not just the short term, but more the longer term. And Jim, you kind of mentioned it earlier. We're talking, the next 2 years, the next 3 years. And this is where it's extremely important to look at where we entered this kind of period of uncertainty. And we entered it from a position of strength. And we make the comment that starting place matters. If we're heading into this period of uncertainty, if we're coming into it with a consumer that's unemployed, a consumer that's over-levered, a consumer that has financial problems, it's a whole different story as compared to, like, you've got consumer balance sheets basically as healthy as they've been in the last 50 years. Right. If you look at it, debt relative to their asset levels. If you look at it,
this is
income
aggregate. You're saying
yes,
aggregate. This
100%.
is not average. This is just aggregate nationwide.
Yes. Yeah. So if you look at it and say, hey, relative to how much debt you have on your personal books, what's your asset level? Or you could look at it differently. You could look at it debt relative to income. You could look at it as in a number of different ways. It all tells you the same thing. Is coming out of 2008, there was this massive delevering that happened for the consumer, in addition to businesses as well. But like the consumer is about as healthy as they've ever been, which puts them in a really good place to withstand some of that volatility and uncertainty. When you start to think about, hey, if I have to live through an uncertain period over the next 12 months, it may not be as bad as if I came into it and I already was struggling to make monthly payments on my debt, right?
Yeah. I think it
The
was,
other piece I would say too is if you look at it corporately, corporate profits, I think this is the next chart. Corporate profits are basically at all-time highs.
and
Right?
I think it was Austin. It was what in 2008. The other way that we've seen, like JP Morgan has put out some data on it, was the savings rate in 2008 was like -2%. People were living on their HELOCs and
Yep.
lines of credit. And in recent years, we've been hovering right around 9% savings
Mhm.
rate, which
Yeah.
is one of the healthiest savings rates. I think to put it in perspective, I think what was it? Not even like 15 years ago in Orange County, the savings rate was -19. I mean, it was terrible.
Stop
So,
picking on Orange County, Christina.
I mean, people were living on home equity lines. So, the consumer is important. The strength of the consumer is important, and I'm not sure if you'll touch on this at some point, Austin, but with regards to inflation, I think we talked about inflation a little bit. But with inflation, you have wage inflation has kept up with inflation. So you don't really have this huge, you still have such a strong consumer because wages have gone up and inflation has come down. But corporate profits, corporations or earnings are still holding on strong. I think if you wanted to go to that last slide for just a second, Jim, which is just speaking to the health of corporate earnings. And at the end of the day, the only thing that will drive the market higher is if corporations still have earnings. Earnings are what drives stock prices higher, period. End of story. If corporations are making money, the stock prices are going to go up. And I think those have been holding on pretty strong. What's your outlook for corporate earnings?
Yeah, I mean, I would say this, Christina, I think in our view, it continues to trend higher, and that goes hand in hand with some of this, efficiency conversation that we've already been talking about, right? You're seeing companies, whether, basically be able to take more to the bottom line because they have become more efficient, and that bleeds right into this AI,
Yeah.
set of slides that we've got here, and really what we're looking at on these next couple slides. It's like you're seeing the adoption of AI and the use of AI at a faster clip than really we've seen really any of the previous, think of it as revolutions, whether you call it the computer revolution, mid to late 80s, early 90s. You think of the internet revolution, mid 90s to early 2000s, to the point where, again, you think about computers, call it year two in the computer revolution, maybe 20% of folks
Yeah.
had a computer in their house, right? You think about the internet, right? How many folks had internet in their house in year two? So think of it as like 1996-ish. It was maybe 25% of people. How many folks are using AI year two? We're at 40% of the population. Like you're already at a higher level of use. And the fact that you're seeing that then goes kind of to that next slide, Jim. If we look at this is that efficiency and productivity conversation. And Christina, to your point about corporate profits and what's driving it, like if you're able to get more output out of the same hours worked, you start to get massive gains in efficiency and productivity. And the best comparison is looking back to the mid 90s. And you can see, generally speaking, before you get some sort of transformative technology, output and hours tend to move together. And then after you get that transformative technology, output starts to skyrocket, hours worked, maybe it still goes up, but it doesn't go up nearly at the pace. And you saw that in the 90s to the tune of probably a 20 to 25% gain in output. You've seen it just in, since ChatGPT kind of came online at the end of 2022, beginning of 2023, you've already started to see that pick up in output. And that's something that you can't really get that kind of back in the bottle to some extent. Like once it's out, it really can transform economies and kind of the greater kind of profitability equation, if you will, for companies that are able to leverage that appropriately.
Yeah, I was reading about just the impact of AI. And if you're watching this and you're like, I didn't really get it. I don't know what's going on. If you're watching this or listening to it, please go out and start using it. Totally mind blowing. And one commentator said there will be a trillionaire by 2030. It's going to result in even more concentration of wealth in very few people because you're going to have these outliers that just do really well. Like look at Nvidia, it just took off, right? That is directly tied to AI. Whether it's that company or something else, you're going to see these flyers, and it makes sense to kind of invest in companies that could benefit from this, right, Christina? I mean, that kind of makes sense. So
The one thing I would say, Jim, when it comes to AI, and this is the thing that we're watching probably most closely, is once you start to get companies outside of the technology sphere to leverage AI, that's when it starts to really transform the economy. Think back to early mid 90s. Amazon was a company that sold books, right? It was in essence a bookstore,
yeah,
right? Fast forward to them using the internet, right? They're the biggest, technology company, whatever you want to call it at this point, consumer company. Again, they fall under so many different kind of segments of the economy at this point, but it's because they took a transformative technology and completely changed a business model that historically had been, pick your book off the shelf and we'll send it to you or you'll buy it directly, right? The only other thing I would say about AI, and as we talk about technology, and this actually ties back into, Jim, your comment about, hey, how does the composition of the labor force change? Like this just looks at what percentage of the employed population is tied to, in this case, the internet. So think kind of technology related jobs. We're almost 20% of the population today. Back in 2008, that was 2%. Even in 2020, it was only 11. So we've almost doubled over the course of the last 4 years. And that level of kind of expansion is one that, Jim, to your point, as you start to think about, autonomous driving vehicles, right? Like you said, there's going to be a number of folks that are going to be without jobs. The interesting part is there are going to be that many more jobs being created because of the development of the economy in different areas that maybe didn't even exist, probably don't even exist today, much less existed, 5, 10, 15 years ago. So I think that's important to think about.
Have you seen the Tesla robot thing, whatever it's called?
Yeah.
I saw one in Miami a couple of years ago. It was in a Tesla store, and I'd never seen one in person. And the smart kids are saying there are going to be 10 billion people on the planet. There will be 20 billion robots.
Yeah.
Which is a lot like, Terminator. Hopefully there'll be
right.
But, each person will have 2 robots effectively to whether they're working in a factory or whatever it is.
Yeah. All right. So we've talked about kind of what the job picture looked like. I think that maybe brings us to this last piece of this section where we talk about strength of the economy, like underlying strong tailwinds. The labor market continues to be a strong point in the U.S. economy. So for those of you looking at the screen, this is a labor market condition index that's put out by the Kansas City Fed. What you're looking at is anything above 0 tells you that the labor market is actually growing and expanding. Anything below 0 tells you that it's actually contracting. Now, you can make the case that, right, it is growing or expanding at a slower rate than it was 2 or 3 years ago. That's absolutely true. You could also make the case that coming out of COVID, labor markets weren't exactly healthy. They were, I would say, probably overheated to the extreme as folks were trying to figure out how to deal with all the layoffs and get folks back into the labor market. Now you're getting back to almost more of a normal labor market scenario where people are healthy. If you have a job, you want a job, not necessarily do you have 7 jobs if you want a job like you did in 2021. But I think what's important is to understand like that labor market as we sit today is in a really healthy spot. Why is that important? You don't go into a recession if you're at full employment. Like you don't have a recessionary environment if folks have jobs, if they're still getting income. Like you would have to see this start to deteriorate. Now, the next slide that we have paints the picture of going back to the uncertainty conversation. If you look at this survey that went out, there is the expectation that unemployment will go up over the next 12 months. I would tell you this is probably the one thing that we're watching most closely here at Horizon is what does the employment picture look like? What does the labor market look like? If you start to see cracks there, that's when you should probably start to say, okay, there's the possibility of this recessionary environment. Throw out all the uncertainty that we talked about earlier. That was very much short term, next 3 to 6 months. If you start to get kind of longer term breaks in the labor market, in the employment picture, then you're starting to have probably more real kind of longer term problems. That's not what we're saying. Like at Horizon, that's not our base case. We're not projecting that. That's just what we're watching to see. Hey, if we start to head down this path, that's where you start to get a problem. Right now, as the previous slide just showed, we're still in a really good spot. So that's the thing that we're kind of paying attention to.
So this says Source Apollo, April 28th, 2025. And what it shows is this real spike in basically this broad expectation that there will be more unemployment, meaning like probably 70% of respondents. Is this a survey that they take?
Yes. Yeah, it's a survey of yeah.
So they ask, hey, will there be more unemployment in 6 months or a month, or what was the time frame on that?
12 months, a year from now. Okay. Yep.
So that's up. People are expecting more unemployment. Just because they're expecting it doesn't mean it's going to happen. But
Right.
is this more of a function of the uncertainty side?
And that's exactly what it is.
Coming from the tariffs.
Yep.
Okay. Right.
Yep.
Yep.
So
And I
this is
think
not-
that what we've already seen is that the job market, part of why the market's also rallied and responded so well, is that even though we're seeing, cuts and downsizing and call it government jobs or what have you, the private sector is picking those jobs up and beating expectations. So I think
Good.
some of this uncertainty has been, what's going to happen as we start to downsize government, but government spending was getting to be an unhealthy level of our
Sure.
GDP. And when you have that much component of our GDP reliant on government spending, it can be a problem long term. But what we've seen is that the job market has beat expectations. I think it was like 280,000 a couple months ago, 130,000 last month. The job market has picked up and beat expectations. So I think we're going to, start to see some of this calm down a bit.
And Christina, that's a great point. You've gotten a lot of headlines around the federal layoffs. Just to put it in perspective of the overall U.S. employment picture, federal jobs make up 1.3% of the U.S. labor market. So even if we lost half of our federal employees, you would expect unemployment to go up to about 4.5%.
Yeah.
Now, again, that's assuming they all got laid off and none of them got jobs back.
Well,
Christina,
also,
to your point,
but
they're
if you have
all
that-
getting jobs.
Hold on. If you want to sell that condo in DC, you might have a problem.
That's a good point.
Because we
That's
were
a
in
good
DC a few weeks ago. My wife and I were in DC, and people are really worried.
Yeah,
The
no, absolutely.
DC housing market is
Yeah. That's
yeah.
tough.
Right. Yeah, maybe that's the one place in the country, Jim, where prices aren't going up. Everywhere else, they're
Well, they're really high anyway.
They're
so-
still high.
yeah. All right. So
city, though.
the
Great
last kind of few things we're going to touch on is we talk about this concept of diversification, and Christina, you can probably talk to it too, is this idea of a portfolio. For probably years, you've probably heard folks talk about a diversified portfolio is going to help you weather the storm. What you've seen over the last 3, 4, 5 years at this point is that's not entirely been true, because there have been, 7 names in the US that have outperformed everybody by 100%. That has started to change, and it's done so in a pretty dramatic fashion for the first time in really years. And we're looking at a chart of growth expectations in the Eurozone and the US. And I would tell you, historically, those generally move in line with one another. They may not be exactly on top of each other, but when growth expectations are going up for the US, they tend to be going up for Europe, and vice versa. Really, for the first time in, like I said, the last 15 plus years, you've seen a pretty wide divergence. So you've had expectations for a growing economy in the Eurozone. You've actually seen expectations, again, talking back about some of that uncertainty, you've seen expectations in the US for a shrinking economy. Why is that important? I mean, Christina kind of mentioned it as you talk about kind of economic activity, how that plays into earnings, how that plays into, markets. That tells you that maybe there's an opportunity in Europe for the first time in some time. So where that globally diversified portfolio may actually start to benefit you for the first time in years. It also helps the next slide, Jim kind of tucks to it. If you think about the currency piece, when the dollar is getting weaker, that's generally better for international stocks, or in this case, we're talking about European stocks. When the dollar's strengthening like it has been for the last 10 plus years, that's generally a better time for US stocks. You've started to see dollar weakness kind of take hold. Again, we'll see if that trend continues. If it does, you would expect international stocks to add more to a portfolio than they have in the last, again, 5-10 years. So that combination of a weaker dollar plus, potential for fiscal spend in the Eurozone gives you the ingredients potentially for help from diversification. Not saying it's definitive.
Uh-oh.
He'll come back.
Diversification benefit.
One of the things too, I think on the international component, we're keeping our eye on it. Just for a lot of our clients, we've had no international exposure really for the last several years. We've heard the value conversation for over a decade. Well, they're valued appropriately. It's a value play. It's a value play, but we really haven't jumped in there. And right now, we're keeping our eye on it. We think it's more of a trade, not a trend. Right now, that's kind of our outlook. Is we're not ready to make that leap to say, okay, let's go all in on international. And yeah, while the dollar has weakened a bit, we also have to put that into a bit of perspective when you have all these trade deficits, and when the US dollar is the reserve currency. There was a recent white paper that was written on just, is the dollar, really weakening that much? But when people are trading with us, or they're, accelerating their imports because they're afraid of tariffs, or they're accelerating their exports, all these things are done in US dollars. And so there's this flood of having to flood the market with US dollars. And when you flood the market with US dollars, it's going to weaken the price. So this is kind of temporary.
You're absolutely right to be watching it. And hear me say this too. We're kind of saying, hey, we're starting to see this. And Christina, you're right to say that, right now it's absolutely still a trade. It's by no means a trend. I think this is something that we're seeing, hey, are these kind of the green shoots of a changing tide, or is it a little bit more of a head fake? I think, Jim, the next slide shows you, like, even if you're not on this trade today, there's a lot of room for it to run if and when it does turn, right? So everybody who's made everybody we've had conversations, with said, well, hey, international stocks are up 9% over the S&P 500 in the first quarter of the year, right? Is now the time to buy them? Like, it seems like now is not necessarily the time to buy. I think, Christina, this goes to your point. The chart on the right shows international stocks have underperformed domestic stocks by hundreds of basis points over the last, 10 plus years. And that's one thing where you've got a lot of room to make up, that if this trend really does take hold, it's probably one that you get some more evidence before making that decision. And then when you do, you probably have plenty of time still on your side.
Translation: when you say the delta is several hundred basis points, that is really, really bad. If you
yes,
all international versus domestic, like, you're sad, okay?
Yep.
But maybe that's turning around.
And Jim, to my earlier point, like, it just hasn't been in your benefit.
Yeah.
And Christina, you guys have done a great job helping manage that for your clients. Like, the diversification benefit, specifically when it comes to international stocks, has not been there over the last 15 years. Just hadn't been.
And then just to put that, I had that white paper, I pulled it up just to put that in perspective on the US dollar kind of weakening. In just 4 months, so in December, the trade deficit hit 98 billion, and then 131 billion in January, 123 billion in February, and 140 billion in March. If we compare that to 70 billion per month during the average of 2024, in just 4 months of 2025, the US has sent 212 billion extra dollars overseas. That's
Yep.
going to weaken our price of
Oh,
our
yeah.
dollar.
Yep, for sure.
All
All
right.
right, Jim, we've got, I think, 2 slides left, and we can kind of move on to questions. But I think the takeaway as we start to think about, okay, what does this all mean going forward? We've talked about uncertainty. We've talked about short term, what that means. Longer term, we think there are absolutely some tailwinds, right? We've talked about maybe the potential for diversification being back on the table. But I think at the core of it is, okay, we still have to deal with the here and now. And we just lived through probably a couple weeks worth, but specifically 2 of the worst consecutive days of underperformance or decline in the market that we've seen in the last 100 years, right? 2 consecutive down days of more than 4.5%. So in aggregate, you were down almost 10% just in 2 days. That doesn't happen. I mean, it happened in 2020, happened in 2008. Prior to that, it was Black Friday. Prior to that, it was pre-World War II. Then you're talking like Great Depression, right? Doesn't happen very frequently. But I think what's super important to realize is even when it does happen, the overwhelming majority of the following time periods, whether you're looking at a day later, a week later, a month later, a year later, markets tend to be higher from there, and kind of what we said at the very beginning, tend to be higher from there, whether that's percentage of times that it happens or absolute return from those actual investments. And you're talking not just, on average, a year later, after those 2 terrible days, markets tend to be up over 15% from that bottom or from that point. That doesn't mean that it's going to be a smooth sail from that bottom to where that is a year later, right? There's likely going to be volatility. We've lived through that, as we've seen just over the last month. But understanding kind of the benefit of being in the market for the long term is extremely important. And I think this chart kind of paints a picture of just how frequently those periods are green as opposed to being red.
And Austin, I think I really like this chart because if you're listening to this and you can't see the chart, this basically goes through all of the times where there have been 2 consecutive days of 4.5% decline. There aren't that many going back 100 years. In all but 2 of the cases, and that would have been 1933 and 1940, which depths of the Depression, World War II, okay? I think we're not living, that is not us right now.
Right.
You've had 1 year later, you've been in the green, so you've been positive. And this is why market timing doesn't work. By the way, if market timing worked, there would be somebody out there who says, I'm the smartest person in the universe next to God, and I've figured out market timing. And people would be investing with that person, but
Yes.
that person does not exist.
Yep. No, and I think this last slide just puts a bow on all of this, right? And we talked about kind of Warren Buffett's mantra, right? You buy when other people are selling. You've probably heard the term buy when there's blood in the streets, right? This goes back to that uncertainty as well, right? If you look at how uncertain things are right now, this is a measure using that uncertainty index. We're at the 98th percentile. Historically, when we've been that uncertain, what's the 1 year forward looking return on the S&P 500? It's almost 20%.
Wow.
Right? On average, I think we all know this, the S&P 500 returns somewhere in the high single digits, maybe right around, low double digits. Like you're getting almost twice that return to be invested over the next year during a period where it may feel like now is the absolute worst time because of the uncertainty. History would tell you it oftentimes is the absolute best time to get kind of the benefits a year down the road.
Well, you know what? This has been a really positive breath of fresh air. There's so much negativity. I will tell you something. I watch the news. I watch the different news channels to see what they're saying. And I always have to, my kids remind me, they go, what are you watching? I get all my news from TikTok. So the funny thing is, these are almost like dying industries, like this media industry. They're struggling to get ad revenue. And it seems like it's all prescription pharmaceutical stuff, which I don't know if those will still be on with price caps, but it's funny because I think certainly a lot of younger people do not get their news from uh, the talking heads on the
Oh yeah.
TV. My
Yep.
kids don't even have TVs.
Well, and just remember that the talking heads are always there to sell
Yep.
fear. That the more you
Mhm.
tune in, because you're fearful that, when people have a high fear index, they tend to watch the news more, and they know if they can sell fear, it's going to keep you addicted to the news headlines. So try to, take a step back and put things in perspective. And I think this is a good summary.
Take a break, play some pickleball, read a book, take a walk, do some gardening,
There you
turn
go.
the TV
Yeah.
off.
Yeah, and I think that the with these takeaways, as Austin kind of painted that picture nicely for us, is that the uncertainty is not completely out of the front of us. There's still some short-term uncertainty. And look, if we take a look at, if history is any indication of how Congress is going to go, the budget's only funded through September, and you've got a massive tax bill that is pending because our tax code reverts back to the prior to 2018 era, effective December 31st. So there are a lot of looming major things that impact, corporate taxes, corporate tax rates, individual tax rates, and it's going to be the political football to get the government funded beyond September 30th. So is that something that, again, takes away anything that we just said as far as what our economic outlook? Absolutely not. But between now and September 30th, when you've got, government funding, tax bill, more trade tariff conversation, it's going to be continued headline volatility. I don't know if it'll be quite as volatile as it was in April, really, of this quarter. I don't know if it'll be quite that volatile, but there's still some volatility headlines before us. But if we get a tax bill, and we get some of this trade uncertainty behind us, Santa Claus rally Q4 is what I would be looking forward to. So that's kind of where we're at.
I love it. Santa Claus rally. All right.
Um,
On that happy note, next time, if you are watching this on YouTube, go ahead to our website and register for this. And if you're watching this live, you can register for it. Inside a legal consultation, what happens when you meet a lawyer at Cunningham Legal? We're going to walk you through how that process works, how you make an appointment, what are all the things that happen. So a little bit of a orientation for people that are making an appointment and doing a consultation with a lawyer at Cunningham Legal. And we do have offices in Northern and Southern California. We've got plenty of offices throughout the Bay Area capital region and Los Angeles region, and we're always available by Zoom, right? Like everyone else. And here's our contact information for Ascent Wealth Management. If you'd like to reach out to Christina Lindsay and her team, Shannon and Alyssa, they have locations spread out through California as well. And we will now open it for questions. And as we go for the questions, we're going to go back to the other slide. So we've got the contact information. But if you're watching this on YouTube, thank you so much, Christina and Austin, for joining us here today. If you're watching this, just keep watching because there's another video that's going to roll right after this one that probably has my face on it. So I will see you on the next video. But thanks for joining us.